As we move through this brand new year, we thank you for subscribing to our podcast. And if you have an idea or two about how we could make this information service more complete for you, we'd love to hear from you. We want to provide some genuine help for our listeners, answers and ideas to help you make the best possible investing decisions. And you can do that two ways. That is, communicate with us here. Use your phone or call anytime. Call our anytime line at 888-99-CHART. That's 888-992-4278. Or go to investtalk.com. That's InvestTalk with two T's, investtalk.com, and click on Contact Us. And thanks again for listening to Invest Talk. For the first time, we have a common approach to cleaning up banks around the world to restructure the world's financial system. So said British Prime Minister Gordon Brown. How will this news on the world stage affect your retirement portfolio? Should it change the way you look at international investing? That's just one of the topics on the table for today's Invest Talk, made possible each day by KPP Financial. It's 1 hour about your money, reducing risk, and making it grow. And now, dedicated to the idea that you can do better than the average investor, here's Portfolio Manager Steve Peasley.
Welcome to Invest Talk, everybody. Of course, this is our Friday edition, April 3rd. Of the show. And I always welcome all the listeners, podcast listeners, investtalk.com listeners, and of course you, the radio audience. We appreciate it. Our number one mission is to help you protect your retirement funds, try to make them grow, helping you make better decisions to make that money of yours grow. Let the money work for you instead of you working for it. You know, that's kind of important. I was talking to someone yesterday, and I said that the important part about as you get older, instead of paying interest, you need to start earning interest. Now, you earn interest through dividends, interest through savings accounts, treasuries. Any way you can start earning money instead of paying it. You know, there's a point in your life when you have to switch that around. Stop paying interest on your mortgage, paying interest on credit cards, paying interest on your car finance of a vehicle. You got to stop doing that at some point and be on the other side. Collect it. That's what you want to do. So that's our number one job, to help you get to that point, how to make those decisions. Now, whether you're looking for the bottom of the market or wondering if we're in a bubble, investing in the market still depends on understanding your options. What's available for investing? Now, we always use tried and true principles here at KPP Financial, and that is, don't buy a stock that's not making money. That sounds pretty simple, doesn't it? Don't buy a stock not making money. If it's not going to make money next year, the year after, hasn't made money last year or the year before, why are you investing in it? Why would you want to own a company that doesn't make money? That's the key to any type of investing in the stock market. Earnings, earnings, earnings are the only thing that really matters. Now, the stock price can be high, it could be low. At the most recent low, the public, the investors, decided that stocks were valued, dollars worth of earnings of a company was worth only about $10 or $11 stock price. $1 is worth about $10, $11. Normally, investors think it's worth between $15 and $19 for $1 worth of earnings. That's called a PE ratio, by the way. And it has been as high in the dot-com bubble as 30 times. And I'm talking about overall broad market averages. Okay? So now it's very undervalued. And it got to a point where it was around 10. Now it's around 11, by the way, moving on up to 12 because prices are moving up. Prices have been moved up sharply, have they not? Yes, they have. Now, so are you looking for the bottom? Have we put in the bottom? I said in a newsletter a couple weeks ago, 3 weeks ago, I don't remember exactly, several weeks ago, that it looks like our market has put in a bottom. And I said, I believe it is the bottom, not a bottom, but the bottom. That's pretty risky to make that kind of call. I'm knocking on wood, hoping it's going to hold up. No one really knows. Markets rallied 20% plus off the bottom. We'll see if that continues. It would be very normal for it to give some of that back before it continues moving up. We'll see. We haven't had a decent pullback yet. We have not. We usually have one. We had an extreme sell-off. There was 15 or 17 days in a row it was down. Now we've had a pretty strong spring back from that sell-off. So we're back at around 8,000 on the Dow, which is pretty low. Pretty low. Remember, it was 14,000 a year and 5 months ago. Okay, so that's still pretty low. Now, the talking point today is about exchange-traded funds, ETFs. They're part of a new generation of products to investors that you can use, and we're going to talk about them. I talked about them at our recent conference, okay? And remember, the title was Thinking Outside the Stock? Thinking Outside the Stock? Well, I demonstrated some ETFs that allows you to invest in equities without really investing in the stock market. There's other kinds of things you can do. We're going to talk about that today. Now, do you understand how ETFs work? Do you know what they are? Have you used them? That's going to be the talking point. ETFs versus mutual funds. What's better? Is there a difference? Now, we're going to go over that. Our question and answer line is open right now. You can call if you're doing a little spring cleaning on your portfolio and need some ideas about which funds to get rid of, which stocks to buy, which ones to sell. Well, you can call right now and get me on the line. I'll help you with the answer. 888-99-CHART is the number, 888-992-4278. Or you can get through to me via the email as well, 888-99chart@gmail.com. And you can send me an email. We'll answer the question on the air. If you don't want to be live, we'll look for it so you can send it right now. Now, the market today followed up. It looked like it was going to be weak. It looked like to me it was going to be weak. But it was the jobs report came out for March. And the market could care less about that jobs report. Didn't care. This is a bad jobs report. We lost 633,000 jobs for March. In 1 month, we've been losing 600,000+ jobs a month for months, number of months now. Lost about 5 million. The unemployment rate went up to 8.6, 8.5% from 8.1 or something like that. Nothing was good about the report, and the market could care less. That is a sign of a bull market, by the way, when bad news means nothing. That means that the investors have built to the price of the stocks all the bad news they're going to build into it. Now, that doesn't mean some unforeseen, unknown thing can't come along and put a big damper on the market. It can do that. It has done it. We've seen it. I mean, we've seen it happen several times in the last year or so. So it is very, very possible. But I don't think, it just feels like things are starting to look a little bit better. The economic news this week was a little bit better. Not worse. The jobs report was bad, but there was good. There was, I don't want to say good. There was less depressing news. We had statistics come out that were better than expected. Better than expected. They're still bad, but was better than they expected. So I think that the market has built into some pretty dire circumstances, and they're not seeing as dire as they thought it was going to be. But earnings season is right around the corner. We're going to start getting earnings report. The question will be, big question, are the earnings going to be disappointing and the